Hello and welcome once again to Globaleye's weekly market review. And joining me again to discuss the main economic and political stories making the headlines is our senior wealth manager Simon Putt. Simon, thanks again for joining us. Well, Simon, as always, we start in the US. We were talking last week about the Fed and Janet Yellen. Maybe they'll increase the interest rates. It was looking pretty positive last week, but even more positive this week. We just got the US job numbers out. 235,000 jobs as opposed to 195,000 predicted. Surely this is now a done deal as regards interest rates.
Certainly the markets think so. Markets are putting a 98 to 100% probability on the prospects for a hike in interest rates this Wednesday. We're looking for 25 basis points increase in rates. One or two people may be thinking possibly 50 basis points, but the consensus is for a 25 basis point hike. And yes, absolutely. The data from last week, the jobs data was very encouraging. Not just the number, but if you look at the detail as well, a lot of the job creation was in the manufacturing and construction sectors. So as it were, longer term parts of the economic cycle, as opposed to just more sort of speculative or transient parts of the economic growth cycle. So there's really a forecast here that this is an upward part of the cycle that has got teeth, that is growing, and there's momentum for the economy to continue to grow. So yeah, very encouraging signs from the US economy, very much justifying that prospect for a rate hike.
So we're seeing nearly full employment in the US. I think the unemployment rate's around about 4.8%. So really nowhere to go apart from perhaps wage inflation, and therefore obviously more pressure on the Fed to take corrective measures to stop the economy overheating.
Yeah, we've seen that as well. The wages data did come out as part of the jobs package, and the data reveals 2.8% year-on-year wage growth, which is precisely where the Fed would like it to be. It's very encouraging, and as you say, some effort to take some heat out of the growth, but precisely the reason also that the Fed needs to take some heat out of the growth by hiking rates to an extent.
Not so positive, though, for the price of oil. Last week we saw about a 9% drop in the price of a barrel of oil, below the psychologically important $50 a barrel. What are the main reasons for that, do you think? And do we see that continuing, or are we now in a sort of a stable price range?
Well, we've obviously had this period of the oil price recovering from 12 months ago when we were below $30 a barrel, and we steadily increased over the last 12 months. To Brent went above $55, for example. The cause of the problem 12 months ago, or over 12 months ago, was oversupply, and much of that was due to the US shale production, creating a glut of stockpiling. Where we are now, 12 months later, obviously the oil price has recovered. It's been very positive for the oil producing companies, but as you can expect, it's also positive for the US shale producers. Suddenly they've been able to turn the taps back on, and there's now a concern over the last week that stockpiles are going to increase again. We're going to be awash with oversupply. So you can almost argue this is creating something of a vicious circle. The price is going to rise, suddenly supply is going to rise, it's going to knock the oil price down. And well, if anything, the consensus across some commodities experts is kind of where we want to be at the moment, because the oil price has risen so sharply over the last 12 months. By no means a bad thing in itself, but pace is important. What we have here is perhaps a necessary period to consolidate, perhaps a bit of a correction. Still longer term, we've maybe looked for a slight increase in the oil price from where we are, but whereas before some people might have been calling for a $65 to $75 range, we're probably now more comfortable in something around a $50 to $65 range. So there's something there for the shale producers in the US, but not to the extent that it's going to drive supply out of control. And in the meantime, we look for this to be balanced to an extent by the cuts that OPEC is implementing.
Okay, well, let's turn to the UK. I've got the budget last week, the British Finance Minister, Philip Hammond. Pretty rosy forecast for GDP growth, 2%, he said, as opposed to a previously expected 1.4%. But really, the markets didn't buy it, did they? Specifically, the currency market, the pound dropped. Now this week, we may get the triggering of Article 50, could be as early as Tuesday. How is that going to impact on the value of the pound? What's your view in terms of the range of the currency price vis-a-vis the dollar, and what do you think the sort of medium-term prospects are for the currency?
These are very difficult questions to answer, Tony. There's so much uncertainty in the system, and your question itself reflects, Article 50 may be invoked this week. Maybe it won't. And there's clearly so much political process at the moment. It's very difficult to read exactly what's going to happen in terms of that and in terms of the impact on the currency. Where we are at the moment, we've been hovering around this 120 to 125 range, sterling to dollar. I think it's reasonable to expect that to be the sort of playing field for the time being, but clearly there is the potential for downside. We hear forecasts, as a potential floor for the currency of 115. You could see it happening. It depends what comes out of the process, and clearly that's got to go through the whole political format in the UK, the Lords intervening in terms of what the Commons can implement as part of the legislative process. It's simply so opaque at the moment in terms of where this is going that it's very hard to make a call. As far as the markets are concerned, clearly stock markets remain very well supported. The FTSE 100, FTSE 250 are both still very much close to their record high levels. You can get that as far as the FTSE 100 is concerned with the weak currency. Clearly benefits many of the constituent parts of the FTSE 100. I would say, there's still some value in those markets and stocks, but I think people have to be a little bit cautious, and the ability to diversify away from too much UK exposure at this time would clearly make a lot of sense.
We're talking about diversification. We continue to see the US stock markets continue to rise, Dow's at record high, etc., etc., etc. Do we keep just a value investors still putting some money into the United States, or are there other places where it may be prudent to look at?
Well, the answer to both those questions is yes. The US is still, I'd say, the first place to look in terms of finding growth prospect. The cycle, as we've observed earlier, is rising. The tide is going to lift the boats, as it were. So there's still some value in the US. You clearly wouldn't want to put all your eggs into the US basket. Developed markets broadly look very good, and you can build some diversity across that. We've talked about the UK, although albeit slightly cautiously. Europe, at this point, looks very good value. Valuations are low. That's notwithstanding, we've got some political process to go through with elections in France, Netherlands, Germany. That is likely going to create some bumps in the road, but with the weak currency, with the ECB committed to stimulating economic growth across the continent, and as I say, with equity valuations being on the cheap side, getting through the politics over the next few months, there's some terrific upside opportunity for continental Europe. Just picking up on the ECB, last week also they had announcements to make, and they were very pleased, even if the numbers don't sound stellar. A 0.1% in growth forecast for this year and next year just give an indication that things are stable, they're on an upward momentum, and the outlook remains comfortable for the continent. And then just rounding out the picture furtherly, Japan also looks like it offers good value at the moment. Funnily enough, Japan is one of those economies that does very well when the US is doing well. So that's what we're seeing at the moment. Again, the currency is weak, it's stable, and companies on the ground are making money, delivering good results. So there's good opportunity across these sectors for investors to find diversity.
So it's all about diversification, diversification, and diversification.
Those three things, and perhaps again. And within that also build a little bit of asset diversification as well. So it's not just equities, but that is the key point.
Great. All right, once again, thanks very much for joining us. We'll speak again soon.
Thank you, Tony.